I had another video planned for today, but when I woke up and saw my portfolio down by 10%, I knew I should cover this topic, mainly because most of my viewers are new investors. In fact, I have gotten many messages from people opening their investment accounts with Scalable Capital or Trade Republic by watching my videos. So I thought it was my duty to at least cover this topic and share what I am doing in this situation. In this video, I will not cover why things are going the way they are. Is it a recession? Is it a correction? The market's falling due to a regional conflict. One can speculate, and even a broken clock is right twice a day. So let's start by quickly going over how my portfolio is performing. I have lost about 2,600 euros in unrealized gains in one day. And over the past week, this loss is about 3,800 euros. Everything is in red, especially my crypto investments. Now you hear many things and opinions on what to do in this situation. Some would point out to Warren Buffett selling 55.8% of his Apple stock and that it's time to sell all of your holdings and go all cash right now. Some would say get into treasury bills or even buy gold. As I have said multiple times, I am not an expert and I cannot give you a thesis or a technical analysis as to whether things would get better or worse. So what am I doing in this scenario? Honestly speaking, not that much different than what I'm usually doing. Let me explain why. During the past 5 years of my investing journey, I have learned to distinguish between investing and trading, and that I have my own investing strategy. And superficially, it consists of roughly 5 points. Point number 1, emergency fund. Before I started investing, I did have a lot of savings in my current account, being eaten away by inflation. But when I started investing, I didn't just put all of my savings into my broker account. I started step by step. I first put in 1,000 euros, then another one, and then steadily made consistent investments as soon as I got my paycheck. At the beginning, I made a plan of creating an emergency fund of 3 months of expenses on the side. This amount was totally separate and meant to be kept as my emergency fund. So in case of emergencies, I would not have to sell my investment, especially at market low points like what we are having right now. Assuming I did not have my emergency fund and needed 5,000 euros today, I would have to sell my investments at a loss. But thankfully, that's not the case. As I said, I started my emergency fund with 3 months of expenses. Then I increased this to 3 months of my net salary, and now I have increased it to 6 months of my net salary over the past few months. Now I know most people would say it's overkill, and I might agree, but this makes me feel safe, and at the end of the day, what matters more to me is feeling comfortable than having this money work for me in the market. And as a beginner or even a seasoned investor or trader, I would really hope that you do have some sort of an emergency fund, ideally 3 months worth of your expenses. So times like these do not stress you out that much. I have discussed how to create an emergency fund in detail in this video if you are interested in watching. Point number 2 is investment time horizon. By investment time horizon, I mean for how many years you expect to hold your investments. For most people, investing should be long-term. Now, long-term can vary for people. For some, long-term is 5 years. For others, is 10 plus years. In my case, my investment time horizon is 10 plus years. Now, things can always change. Nothing is written in stone. But in general, whatever I am investing, I have no plans of selling until 2030. Having a long investment time horizon means that even if there are huge market fluctuations, given a long enough investment horizon, the overall market provides positive results given that you have a well-diversified portfolio. As you can see from my portfolio, I am heavily invested in the US stock market, and even within that market, I am heavily exposed to the IT sector and have exposure to crypto. Hence the 10% drop in a day compared to the 1 point something drop in the S&P 500. But as I said, I have a 10 plus years investment time horizon. I can easily handle the market fluctuations, as in most cases, the market does provide positive results given a long enough investment time horizon. Point number 3 is diversification. Having a well-diversified portfolio is essential if you are a passive investor. And in most cases, an ETF like the S&P 500 or the MSCI World ETF is a great choice to have. With these ETFs, the US market in case of the S&P 500 or the developed country markets with the MSCI World are covered. Over the past 15 years or so, the S&P 500 has performed way better than the MSCI World, mainly due to the fact that it has no exposure to markets other than the US. In my case, as I have just shared, I mostly have exposure to the US market and more specifically to the IT sector, hence a higher volatility. I can increase my diversification by investing in an MSCI World ETF or the S&P 500 ETF. But I think in the near term, most of the growth will still be in the IT sector. As we have seen the recent AI stock boom, I am more certain that the AI boom will not continue, but there will be still more significant developments within the IT sector. Now, there can be something like overlapping exposure. Let me explain. I have invested in the S&P 500 IT sector ETF, and I'm also investing individually into Apple and Microsoft, even though the S&P 500 IT sector ETF has both of these companies, and I'm knowingly overexposed to these stocks. But I have seen many people, especially ETF investors, doing this unknowingly. Just the other day, I had a talk with someone who was having savings plans in the S&P 500 ETF, the MSCI World ETF, S&P 500 IT sector ETF, Renewable Energy ETF, and a couple of other ones. I asked him why he was investing in ETFs with overlapping company. To that he said he had no idea that there were such companies or stocks which were repeating in almost all of the ETFs. Not only was he overexposed to a specific sector, he was also paying an ETF fee just to invest in the same set of companies. So such a kind of diversification also makes little sense. Point number 4, do not listen to a single source. Let me repeat that. Do not listen to a single source, even if they are an authority. This applies to me as well. Please hit the like button if you feel that I am providing value, but even in the case you believe that I am honest and provide you value, please do not listen to just me. Listen to multiple sources. Look at different channels. Because I am a human being and so are most of the sources out there. And we can make mistakes. I am 100% sure that I make mistakes. That is why it's absolutely imperative that you listen to different sources, especially when it comes to your finances. I personally like various sources. For example, The Morning Brew, Yahoo Finance, Seeking Alpha, YouTube, and many other sources. Let me know in the comments below if you want me to share any paid sources as well. Now, even if I respect the person or the organization, I too get my info from multiple sources and do not blindly follow anyone. Point number 5. Learn to handle red days. Days where your portfolio is just showing red are very difficult to handle, especially as a beginner. And if you have started when the market has started going down, each investment feels like you're burning your money away. Now imagine if you have just found a €100 bill on the ground. You're super excited, right? That's like making a profit in the stock market. You see the value of your stock go up and it feels really good. Now imagine you put that money in your pocket and later you will realize it's gone. You'd feel pretty upset. Maybe even more upset than you were happy when you first found the money. This feeling is what's called loss aversion. It's a psychological thing where losses feel way worse than gains feel good. In the stock market, if you see your stock go up and you're €100 richer, that's exciting. But if those same stocks then drop, making you €100 poorer, the pain from losing those €100 is much stronger than the joy you felt from gaining it. So even though on paper you're just back to where you started, it still feels like a loss because your brain is wired to hate losing. This can lead to people making bad decisions in the stock market, like holding on to a losing stock for too long because they don't want to lock in their loss, or selling winning stocks too soon because they're afraid of losing their gain. To be honest, this feeling never goes away. I too had this feeling today when I was looking at my portfolio. Seeing half of my unrealized gains wiped away in just a few days really hurts. But with time, this feeling gets easier and you learn how to handle red days better and try to make better decisions with time. If you ask me, starting to invest when the stock market is down can be a good idea because it gives you more time in the market as the market recovers. Historically, the stock market tends to go up over the long term, even if there are ups and downs along the way. By getting in when the prices are lower, you set yourself up to potentially benefit more from the long-term growth. In case you want to know how to get started, you can watch this video. And in this video, I share financial milestones that you should be celebrating. So thanks for watching Blood Kizun, and I'll see you in either of these two videos.